Well, a late rally on Friday night in US shares has spared a lot of investors some heartburn over the weekend because a big bounce back in US shares meant that the overall weekly performance for share markets globally was not as bad as it might have been. And the markets were led higher by a focus on blue chip stocks, the Dow Jones Industrial Average up around 2.5%. The S&P 500 up around 2%, the Nasdaq up almost the same. That big bounce back really meant that it was a much better week than it might have been. The S&P 500 finished the week almost flat, down just 0.1% after a very rough week. However, that focus on selling in tech shares and semiconductors and those stocks related to semiconductors and the AI exposures meant that the Nasdaq, despite a big rally back on Friday night, still finished down for the week 1.8%. And of course, markets in the Asia Pacific region didn't participate in that rally on Friday night. They may well do today. In fact, futures are indicating that. The Hong Kong market finished down 3% for the week. Futures are indicating a gain of about 1.8% at the open today. Similarly, the Australian market was down 1.8% last week, and futures pointing to a gain of about 1.25% at the open this morning. The standout, though, in terms of futures performance on Saturday morning was the Nikkei futures. They're up 3.8% and looking like the Nikkei might once again go for a rip higher in trading today. Of course, within the indices, the individual stock stories were very different. And one of the key thematics last week, and something for investors and traders to be looking out for this week, is the huge reactions to individual stock company reports. So we saw Amazon down 12% last week, Oracle down 13%. Now, these are considered the losers out of the AI implementation, that their businesses will be devastated. And the results that they put out did not help address those issues. Newmont down 10.6% last week, and the world's largest listed global miner, clearly reflecting in its share price action what's happening in the gold markets. Gold finished the week just below the 5,000 mark, well down from those highs we saw just a few weeks ago, near 5,600 US dollars an ounce. And the pressure and the explosive moves in precious metals are likely to feed into trading in the resource sector as well. Amongst all the individual stock pressure, one standout result was Commonwealth Bank of Australia, the CBA. It was up 6.4% last week, the top performer amongst the big four banks. Admittedly, it had been under extraordinary share price pressure, having led the banking index higher. It then came under sustained selling pressure. And it looks like at least some of that pressure has now eased with the performance that we saw from CBA last week, particularly notable when the broader market is down almost 2%. So we're looking for further gains in Australia today. At the moment, it looks like it'll be across the sectors. Thematic that's emerging in the US reporting season is the fact that we've seen industrials and material stocks provide the best earnings surprises. And so we'll be looking to those key areas of the Australian market to see if we get similar. But this week, we've got CBA, Westpac, CSL will report, as will Cochlear. And in the US, we've got Coke, McDonald's, Ford, and BP, some of the old world economy stocks reporting in the US, and we get a good read on the broad picture for the US consumer and therefore the US economy. And of course, the Australian earnings season really getting into full stride this week. Plenty of big names reporting. We kick off with car sales today, and we could see once again a very volatile earnings season, because that's what we saw in August. It was one of the most volatile reporting seasons we've seen in some time, and analysts are expecting further volatility in Australian company earnings as we return to growth. Now, after some very rough years here in Australia and disruption to the economy, for the first time we are looking at an analyst consensus, first time since COVID, an analyst consensus of earnings gains across the board for the top 200 shares. And consensus is fairly broadly based, somewhere between 8 and 13% growth across the index is the forecast. Interestingly, though, there is a forecast that growth will then slow in this half of the year, down to something closer to 5% across all of those companies on an annualized basis. before accelerating again in the second half of the year. So, excuse me, analyst forecast at the moment is for a bit of a U-shaped earnings recovery with good strength delivered from last year, further pressure in the first half, and an increase, an acceleration in that earnings growth in the second half. Now, that's a fairly specific prescription for the Australian economy, and I think it does reflect the uncertainty, particularly as we make that shift back into a rising interest rate environment from an easing environment. So plenty of uncertainty, likely to be very strong reactions to Australian company reports this week. Good time for investors to be paying attention to the stocks that they own. Looking across the sectors, we are looking for miners to lead. Copper, aluminium, gold, and lithium exposures in particular will be of interest. Health stocks, we're looking for recovery. Now, I would point out that the health sector itself is very widely spread. The industries within it are very different, from pathology businesses to the provision of aged care services, to provision of hospital services, to those who are doing medical research. These are very different businesses, although all in the same industry, and they have different earnings profiles. So, but the overall optimism around the outlook for all these different businesses is a positive. It's been a sector that's been under pressure after years of support on the basis of demographic growth. Nonetheless, health back on the radar. We've got some key factors on the macro as well, and we do have plenty of data out this week. Locally, we'll see inflation data. In the US, we've got retail sales ahead of non-farm payrolls at the end of the week. And in China, we've got employment data as well as some growth numbers coming out as well. So all of those important to the outlook for the market. Demand in China, one of the key factors for the Australian economy. So data this week that speaks to that could be helpful or not, depending on where it falls. And we've also, of course, keeping a weather eye on the potential for the reintroduction of tariffs and for geopolitics to flare up again. So plenty for investors to be keeping an eye on this week in both the micro and the macro environments. Turning to our watch list, top of the list today, CSL. Now, I've mentioned before that I am only the second best investor in my household. My wife is still holding CBA shares that she bought in the float in 1995. She now receives as much in dividends every year on that investment as she initially invested. So as the second best investor in our household, I'd like to tell you that we have been buying into CSL. Now, you might say that when I look at CSL, I'm talking my own book, or you might say that I'm being sincere about it, but that's full disclosure. I've recently bought into CSL, and the reasons for that are pretty straightforward. This is a global blood products business that has demonstrated a track record over more than 2 decades of an ability not just to expand geographically and globally and through products, but its R&D pipeline has proven to be a consistent deliverer of more and more product. And CSL, a globally significant healthcare company, in my view. The big share price fall we've seen from over $300 a share to under $200 a share, in my view, has put it into a very interesting spot. The growth to lift the recovery in the share price is only modest. Forecast at this stage for CSL are very modest. A number of significant global investors have recently lifted stakes, including Vanguard. Its stake is up to 6%, and a number of analysts, of course, have buy ratings now that we've seen this much reduced share price for CSL. Walmart, also another stock on our watch list this week. Its shares were up 10% last week. It's the first bricks and mortar retailer to reach a $1 trillion market valuation. Walmart has a new CEO, has plans to increase the number of its supercenters and a number of digital initiatives. And there is an argument among some analysts that Walmart is no longer a bricks and mortar retailer, but rather it's a platform that also has some bricks and mortar stores. Now, that's one for investors and analysts to argue about, but there's no doubt that the platform is now delivering. Overall share price up 29% over the last 12 months, with a number of analysts maintaining a strong buy despite those share price gains for Walmart. And sticking with the retail theme, Mart, one of the newest retailers, one I personally find hard to take seriously, but nonetheless, it led Hang Seng gains last week, and that I can take seriously. Up 28% year to date. Now, It's still down 26% from the high seen last August at the height of the Labubu mania. But nonetheless, that big bounce back means that half of those losses have been recaptured. Apparently, my market surveillance team tell me that this has to do with a product known as Twinkle, which is selling very well. They've also enacted a buyback, and although the amounts are modest, it was seen as a positive. Many analysts now moving to a strong buy. If Pop Mart can once again pick a trend and sell like hotcakes into it, they might well see a resurgence in the share price to match.